Welcome back to Just Ask George. David Wolf here with the head dude, George Lovato.
What's up, man?
I'm good. I had a good week. It's Friday. We do these on Friday. I think our audience knows that.
We love Fridays because it means we get to hang out and do this. Then we usually have a really good lunch that we have Kylie bring in from some special restaurant. I'm getting hungry right now. And today we have a live audience.
We have a live audience in the studio.
Yeah.
Great to have you with us as well. And it may be the beginning of a trend that we're setting here. You
who
never
knows?
know.
Who knows?
In the
we'll have
BH
them back
Capitol Theater
every Friday.
So, is there money out there, George? We some months ago, you introduced within the realm of BH Capital, the products and services, a product called the Microloan. And tell us, what were you observing in the marketplace that businesses needed? Why did you create the micro product? Most of the transactions you were looking at were $1 million and higher, and
Correct.
had a full, robust complexity to them in many cases. So,
well, most of the request base came threefold. First, the affiliates came back and said, back in the day, back in the 80s and 90s, we used to look at small deals and we would take them on. But it just got cost restrictive. And then we started becoming a big SBA producer. We did a lot of SBA lending, matching the two halves together. And then SBA got a little crazy and the program switched around, and preferred lenders, banks, really didn't want to do operating loans. They just wanted to do the real estate. And everything that they did under a certain level was always SBA guaranteed. And, it sort of made their financial position look better, but it really wasn't serving the market. Hence the crash, 2008. Basically, small business lending, $1 million and under, just died. If it was operating money, banks just weren't doing it. Now, they might look at the real estate, but insofar as anything else was concerned, the affiliates are ringing the bell saying, hey, we really ought to get back because there's a void there. Then the ever-famous, well-published, unbelievably well-read director, producer, soothsayer, Steve Garth,
yes,
our director of Just Ask George, sent me an article, and it talked about this tremendous void out there. And I sent it to you, and and this was back the early part of last year. Mm-hmm. So we just basically went to the marketplace. I went and called a lot of my financing participants and finance partners, and I said, look, $1 million and under, equipment leasing, commercial real estate, asset-based lending, receivables financing, any of the above. Here's what we're going to send you. You can charge a little bit more because they're a little more intense in terms of construction of the underwriting. All we're going to do is we're going to send a real simple doc request. We're going to put that package together, and then we're going to shoot it to you. We're not going to do any of the normal underwriting we normally do. No balance sheet analysis, not helping them with feasibility studies, need and necessities, that sort of thing. And when that is required, they're going to have to pay for that. But for $2,750, boom, they're out the door, and we'll send it to a minimum of 3 and maximum of 9 different lenders.
Right.
Okay, so take BH Capital, don't give it steroids, and you get this skinny little program that's designed to just open the door for that businessman to a whole new marketplace that he can't get to now.
Question for you. Will these participants that receive the packages that are not fully analyzed and due diligence-ified, will they perform many of
they're going to do
those functions?
They're going to do their own underwriting.
Okay.
So we take that out of the formula. It's squarely put in their lap. So the speed from that point, where it gets very fast for us because we rush through that and push them out the door. We take care of that underwriting in a standard CFCA or corporate finance consulting agreement engagement. That's gone. So they're going to take a little longer. We take the guesswork is in it. It's not taken out of it. But these are sources they can't get to. Okay, but there is there's a difference. And not every deal under $1 million is a microloan deal.
And that's one of the things we really wanted to put some box around, because really micro refers as much to the process as it does to the size, doesn't it?
Exactly. You hit the nail on the head the other day when we were talking about this.
Right.
And that's exactly it. A situation has occurred more than once now with affiliates when they said, I've got a microloan deal, and they send in a $750,000 request, and it's a piece of commercial real estate. It doesn't have an appraisal attached to it. There's no feasibility study, and there's no need and necessity. Okay? The problem is it really does need the extra horsepower that we're going to give it to get it done, because it's more complex. It isn't an owner-operated, occupied building.
Right.
In this case that I'm speaking of, this was a fairly large office building. It existed. There was a first on that office building. They wanted a second to add on to it because they had a whole group of other tenants that were going to move in. All right, so that's way more complex. And then we had a situation the other day where someone sent in a $900,000 request, and it was timing difference financing.
Yeah.
But it was purchase order, it was then receivable, and then it was inventory.
With the inventory.
Yeah. And there needed to be a market value financial statement. There needed to be extended footnotes in the financial statements about the inventory.
Okay.
And there was, again, another tiny segment attached to it, which was work in progress.
Yes.
So, it was a $900,000 request, but, effectively it was it needed to be 4 integrated credit facilities into one. And that's a highly specialized type of lending.
And that integration preferably happens at the BH Capital stage rather than... Right, because you're going to, in other words, to coordinate the participants external to you.
Yeah, let me give you one example of when a micro isn't a micro. And we've talked about this.
Brilliant.
Everyone knows we're financing a very high-profile company right now. And when we saw the original balance sheet on that company, it looked terrible.
Right.
But I could tell that there were loose parts to it. Then we looked at the accounts receivable, and there was several accounts over 90 days. But those accounts that were over 90 days weren't actually delinquent. They were making regular payments on their account, and there was a prescribed loan agreement in place so that the money was coming back in, and that number over 90 was shrinking. So what I did is I said, okay, first of all, let's take all those accounts over 90 that are actually paying you on a note, and let's put them into short-term notes receivable. Notes receivable.
Right.
And let's take them out of the over 90. All the rest of the stuff at current 30 and 60 was performing. Then there were a whole bunch of short-term notes from the shareholders. Well, the shareholder's not going to foreclose on himself. I mean, it's just not going to happen. So I went back and had the lawyers come in and put a document in place, which was a subordinated debenture that was a year and a day long, so it dropped it down to long-term liabilities. So now we actually changed the ratio of the balance sheet.
Yes.
We've got
I'm with you.
Notes receivable here.
Cleaned up the AR, notes receivable.
And then dropped what was short-term liabilities to long-term liabilities.
Because it's 12 months in the one day.
In the one day.
Yeah,
okay.
Right.
And it was subordinated.
Right.
So then there was an extended footnote in there about how that worked. Okay. So all of a sudden, got a brand new balance sheet. The AR is all cleaned up now.
That's great.
And it made the transaction fundable. Okay? But to that point, everybody that looked at it said, a bomb has gone off on this financial statement. And they didn't understand why there had been so much paid in capital. What did we do? We put together an extended footnote that explained how every dollar was spent to get the company to where it is right now.
Okay.
Guess
what? So
what?
you rationalized the paid in.
Everybody got it. they said, yeah, all the hard money's in. This thing's ready to explode, which it is. So right now we're closing a $500,000 piece. We've already closed slightly less than 100. Now we've got, because they needed money for what's called transitional financing. Then there's a $500,000, and now there's an equity piece that we're putting in that's going to be another $1.5 million, $2 million. All of those are really small, so the average guy is going to say it's a micro deal, but it really isn't.
No,
okay?
It was not.
And it's
structurally,
not. Structurally, it was very intense.
That maneuvering and that rebalancing the balance sheet, the re-engineering of it, takes time and effort, and that's what you're paid to do.
That's the difference. We would not do anything close to that in a microloan engagement. We would have requested the documents, shot it off, and when everybody put a bullet in it and said, sorry, can't do this, it would have been game over.
Right.
In this case, this was a full engagement, and it wasn't I didn't start out as a micro deal, even though there were a lot of small parts to it.
And for the business owner, they may say, well, look, I've got to pay, relative to the capital I'm looking for, at least at the moment, this retainer, this professional fee feels proportionately high. But the truth is unless this structure's in place, that initial request and whatever's behind that they're not going to be set up for the longer term.
They won't get their money.
So they shouldn't think of it strictly as, I'm spending whatever the number is, $50,000, let's say, for a $900,000 loan. Well, that feels like a lot for the $900,000 package, but let's get this thing organized and set up right. It's an investment. And I want to bring this up as well. When a company engages the services of BH Capital, they're investing in the capital formation process, which is capitalized on the balance sheet. You've said that. Do I have it right?
Yes. That expense is really not an expense. You're capitalizing that on your balance sheet. So I'm an asset, not an expense.
And he's an asset every Friday, let me tell you. And when lunch comes,
I'm even better then.
No, but really, as a business owner, so this is strengthening the balance sheet. It's not.
We don't have a negative impact. That's what I try to get across to people time and time again. Look, yes, it's cash out, but you're getting it back because you're booking it right back on your balance sheet. So,
and you got his brain looking at your balance sheet and your financials, so that not only are you bankable for the first 900 or whatever micro amount.
Thank you for saying that. But the interesting thing is that the people the client should be doing what they do best, which is running the business. Corporate finance is a whole different skill set. It's a different set of books on the shelf of the business library. So that's why you bring us in. You don't bring us in so that we can go package a loan. The micro
and stroke a check. Exactly.
Right.
So to speak.
Yeah. In the micro loan process, the people that are standing ready, willing, and able to receive the packages from BH Capital are very liberal, very aggressive. Okay. That's a key point.
These sources you're not going to find them down the street.
No.
That's the point.
They're very aggressive, they're very savvy, and they understand the void in the marketplace.
Okay.
They're not going to be as cheap as maybe what your bank would do, but your bank isn't doing it. So you've got nothing to compare it to.
There's nothing.
People say, well, my bank, when last time I borrowed money.
Well, what was that?
1991,
Right.
It was only 6.5%, and here I'm paying 9.25. Well, guess what? There's a cost to availability.
Exactly.
So if it's there, that's the current cost of the money.
And the risk in not doing the deal that way is that you won't have the capital you require to grow your business.
Exactly.
And that's the risk.
And let's just touch on one point, which is cost of capital. We were talking about how all the costs, accountants, accounting, and the example I gave you about this very high profile client, he had to pay lawyers to fix the documentation so we can drop those short-term notes down to long-term. We had to redocument the notes that we moved off the accounts receivable and onto short-term notes due rather. And that had to be redocumented again. The accounting that needed to be done with the extended footnoting, etc., all of those those were costs. Okay, they had to pay lawyers, they had to pay accountants. Some of it was organic, it was internal. They paid us. Then there's another third-party opinion, which brings up the final subject about third-party opinions. When you're looking for the microloan or looking at the microloan product, if you've got a piece of commercial real estate, you still need a current appraisal, and you're probably going to need a need and necessity and or feasibility. So you can't, just because it's under $1 million doesn't mean that you aren't required to present those third-party opinions. You still need financial statements independently prepared by an accountant, compiled, but nonetheless presenting internals. It lessens your chances for an approval. So there's still those costs of capital formation associated with the microloan. They don't disappear. We're just taking our part of the participation and making it micro.
So once one of the participants, the sources, comes in and they're going to have their list of here's what we need. So the money will be spent along the way in the process.
There's going to be other costs.
Our involvement
there's going to be other costs. It doesn't go away is my point.
So we should be able to say to our clients, and this is for affiliates as well, anticipate what behind
accounting,
the 2750, all those things.
Knows?
You don't know what it's going to be, but you better have a budget.
You better be prepared, because they're going to have to read the documentation provided by the lenders.
It's key.
Send it to a lawyer. You're going to have to have those financial statements prepared. You're going to need that feasibility or need necessity. You're going to need the appraisal. Right. You're going to need all those things. So think about it in your own head and with the relationships you do have, and calculate a budget.
Yep.
So
there it is.
There it is.
All right.
We did it again.
Once again, I just asked George, and he produced brilliance.
And Co-Dude,
thank you.
The co-pilot, the Co-Dude, he brings it in every single time.
Is there money out there? Absolutely. There's also information and resources. TheOpportunityEngine.com. Check that out for your email marketing, business email marketing needs. Of course, we're always at www.justasgeorge. Sorry. We are Just Ask George Radio. I was going to go another place. JustAskGeorgeRadio.com, or the home base, the home site, the brick and mortar of digital world with BH Capital, BHCapitalLTD.com. We'll see you next time.
Hey, man.
Am I there?
Okay. You're there.
Have a good week.
Be good.